Bonds are generally seen as safer investments than things like stocks, but bonds are not without risk. The hazards of this hole are going to help you remember those risks. First thing we notice is the wind is blowing really hard. That's going to influence where our ball lands. That's like interest rate risk for bonds. Interest rates in the market influence the price of existing bonds. If rates go up, then prices go down. And if rates go down, then prices go up. To mitigate the wind, we can hit our ball shorter because the longer the ball is in the air, the more influence the wind is going to have. With bonds, the longer the maturity, the more influence changes in interest rates will have. But there's a trade-off because buying shorter-term bonds generally comes with lower interest. Next, we see the course marshal. He's on his phone to represent call risk. The marshal can kick us off the course if we're not making them any money. Maybe we smuggled in our own snacks instead of buying theirs. Or we're playing too slow and backing up everybody else. That's similar to how a company might call your bond if you bought it and then interest rates go down. Say you bought and you're holding on to an 8% bond, but interest rates go down and now the company can borrow at 5%. They're not going to want to keep paying you 8% when they can pay somebody else 5%. Now there can be call protection. For example, maybe the bond isn't callable for the first 3 years. So even if you buy the bond and interest rates go down tomorrow, there's nothing the company can do until the call protection period is up. The other protection could be price. The par value on the bond is $1,000. If the bond is held to maturity, you would get $1,000. But there's a provision on the bond that says if the company calls it, they have to pay you a premium of $50. So when the company calls the bond, you get $1,050 instead of just $1,000. Next, we have a water hazard. If you hit the ball into the water hazard, you're going to have trouble getting it back. The liquid water represents liquidity risk. That's the risk that you buy a bond and then later can't sell it quickly at a fair price. To avoid the water, we can just stick to hitting it in the fairway. Let's play it down the middle. With bonds, we can stick with larger, well-known issues that have active markets. Another option is just to hold the bond to maturity. Next, we see this kid hiding in the bushes. There's a risk he's going to run out and steal your ball and you won't get to finish the hole. This little menace is named credit risk. Like with the bond, credit risk is the risk that the issuer can't meet the obligation. In that instance, you may receive payments of interest and principal either late, partial payments, or no payments at all. To mitigate credit risk, we can buy higher rated bonds and diversify our holdings. Lastly, we have a sand trap with an inflatable flamingo. That represents inflation risk. Bonds normally pay a fixed amount of interest. That fixed amount becomes worth less and less over time. Let's say you bought a 100-year bond in 1926 that paid $25. You could buy a whole cow with that $25 back then. In 2026, you could barely get a hamburger. The higher inflation runs, the more it impacts your bond. TIPS are one option to mitigate inflation risk. Remember, TIPS are Treasury inflation-protected securities. The other option is to buy stocks, which generally increase with inflation. Now to recap, the wind is like interest rates, which pushes your bond price around. The marshal calling is like call risk, where the issuer calls in your bond. Now the liquid water should remind you of liquidity risk, or the risk that you can't sell your bond quickly at a fair price. The credit risk kid can take your ball and not let you finish the hole, like an issuer defaulting on your bond. And then the inflatable flamingo represents inflation risk, where fixed payments become worth less and less over time.